There, this is Michael with Buffalo Finances, and I hope you're having a great day. It's tax season, so I'm getting a lot of tax questions, which makes a lot of sense. And one of the questions is, what are some of the things I'm missing when I do my taxes? What are some errors that we see happen? Well, let's just go through a couple of them. If you are married or uh, and you have kids, one of the things I typically see is people asking about, should I have married filing separate or married filing joint? So 99% of the time, married filing joint is the better option. Married filing joint is going to give you more money back or give you a lower tax liability, and that's because of just how they have it structured. And there's only a very few cases where it's going to be better to be separate. But for at our firm, we run both scenarios, and we say, all right, if you run married filing jointly, you're going to owe $20,000 or have a tax liability of 20 grand. If you do married filing separate, you're going to have $25,000 liability. And so we just pick the one that's lower. All right, so that's common, is which one to pick. Just run both scenarios. You can have a lot of theory, but just run both scenarios. Just change the status. We do that as a convenience. Uh, Next, claiming dependents. It gets very fuzzy about when you have an older child. That's normally when the question comes in, if they can be claimed or not. Once they're over 18, you have to consider, are they actually a dependent, and they might want to claim themselves. So you should definitely file your taxes before your child files their taxes once they have an income, because they might claim themselves and just screw up your whole thing. That happens a lot, where you say, hey, Junior, it's time for you to be an adult and file your own taxes. So they go file their own taxes, they claim themselves, and then the parent does not get the benefit, and they go, oh gosh, what should we do? Well, you should definitely have them amend their tax return, and then you should file with them as a dependent, because you're going to get a much bigger tax break than them, because they probably don't owe any taxes, or at least they won't owe any federal taxes, or a very, very low amount, unless they're making a lot of money, which they probably aren't. You're probably making more money than your child. All right, there's another one. Um, Reporting income. This one is challenging if you have multiple ways you get paid. So if you just have a W-2 or you have one source of income, really simple. But if you have many ways that you get income, like you get money from a side hustle, for example, then you got to track that, because if you don't track it, you're going to get hit with huge penalties when the government finds out that you didn't report all your income. You don't want to do that. You want to be honest. You want to have integrity, and as Jesus says, pay your taxes. It's you're going to have to do it. So don't try to hide it, and don't just think, oh, I don't know how much I made, so I'm not going to report it. You got to find out. You got to find how much money you made. And every company that pays you more than $600 is required to give you a 1099, unless you're incorporated. Different story. But most people that I'm talking to have an LLC. Maybe they've selected an S corp election. But either way, report all your income. Make sure you get everything on there as income. And then deductions. Deductions can be very confusing. So the rule is, it's not deductible unless it is. Unless there's a specific rule that says this is deductible. And most people bring things to me that they can't deduct, but I appreciate them trying and letting me figure it out instead of them guessing. So if you are an individual, then you need to have enough of the 4 itemized things to make it worth adding up expenses for your personal tax return. But if you have a side hustle, then you're going to want all your business expenses. Pretty much every business expense is going to be deductible. So capture all of those things. And we have templates we recommend. But if you're running a business, absolutely get QuickBooks or Xero or Wave or something like that. Don't keep track of it in a spreadsheet unless you hate life, because they have tools that are not that expensive that will do the heavy lifting for you. And you have better things to do than put things in a spreadsheet or add up all your receipts. Okay? And if you do it wrong, we're gonna have to charge you. Like, accountants are gonna have to charge you to fix it, and even if they don't tell you, they have to build that in. I don't want to jump all over the place, but the big 4 for personal taxes, what are those? Medical, interest, taxes, and charitable contribution. So medical is not medical insurance. That's a different thing. It's not premiums. It is copays, deductibles, out-of-pocket expenses for medical, and they're not all going to be even considered in the base calculation. But so you have to get above 7.5% of AGI, which you don't have to worry about that term, but you have to have a lot to make it even eligible to consider as deductible. Then you have interest. Mortgage interest is the biggest thing I see, but any interest that you pay on loans, just bring that to your accountant or put it in your software. If you have a very large mortgage, this is going to be a big number. Taxes, such as state income taxes and property taxes and sales taxes, those things you can consider towards as a deduction. That caps at 10 grand. Once you get to 10 grand, there's nothing else to add. Just stop. So if you have state income taxes in a big tax state like New York or California, you're probably going to hit that number right away, really, really fast, because they have very high tax rates. And then the last thing is charitable contribution. So that if you give a lot in any of these 4 categories, we're going to add those up, and we're going to see if that number is bigger than your standard deduction, and that the standard deduction is dependent on your filing status. All right, so that's a common thing, making sure you get all those. And probably the largest one, I'll end on this one, the largest one is filing on time. You are responsible for filing on time, and the government's not going to remind you when your taxes are due. So if you're an individual in America, April 15th is your filing deadline and your payment deadline. You can extend your filing deadline by 6 months, but you cannot extend your payment deadline. And the government wants most of their money by January 15th, not April 15th. So if you don't pay them any money in taxes and you owe them money, if you owe them money on April 15th and you didn't pay them until that moment, they're going to be very upset with you, and they're going to charge you an underpayment penalty. That you don't want that. So you should pay as much as you can during the year up to January 15th, and then you'll true it up on April 15th. That's how you should think of it. Pay in all year long, figure out what your taxable rate is, whether your marginal rate is 22% or 35%. It depends on your tax bracket, and I can help you with that. But you want to pay in as much as you can before you even get to tax time. All right? I'm going to pause there. Hopefully you're having a great day. I'm doing lots of taxes, helping a lot of people. We can help you too, but we do have limited capacity. So if you want assistance, you better reach out. You can reach us at cpa@buffalofinances.com, and we hope you're having a great day, and God bless.